Welcome to i-TUTOR Economics NCERT series. In the last class, we covered up to the concepts of national income from chapter 2, and today let's continue from the point where we stopped and move ahead with the remaining topics. So let's start with the methods of measuring national income. Methods of measuring national income. So, national income, we know what is meant by national income, right? National income is the total value of all goods and services produced in a country in a year. And everything produced is either consumed or saved or invested. So, you can measure it in three ways, but all give the same results if done correctly. Okay. So, income is always equal to expenditure. Remember that income and expenditure is always equal. So, let's look at the different methods from which we can calculate national income. We can use production method, income method and expenditure method. Okay, first production method or value added method. So look at the value of goods and service produced. So we can add up the value added at each stage of production to avoid double counting. So how can we calculate it? We should calculate the value of all final goods like cars, TVs, foods and so on. Then subtract the value of intermediate goods used in the production. So first take the value of all final goods and services and subtract the intermediate goods and services value from it, like steel for cars, and then sum up the value added by all the industries. So let's take an example. Okay, suppose wheat produced by farmers is equal to 1 lakh. And he sold it to a bakery worth 50,000, and worth 50,000 is used in bread. So how can we calculate the value added by the bakery? So it's 2 lakh, that means bread price minus 50,000, that is wheat price. So what is its value? 1,50,000. So total GDP is equal to value added by all producers. Now what about income method or factor earning method? I'm just introducing the concept, we can study it in detail. So what is meant by income method or factor earning method? So look at the income earned by the people and firms in the production process and add all the incomes, that means wages plus rent plus interest plus profit. So first add these things so that we will get the income method. Suppose for example workers earn 50,000, landowners they earn 10,000, firms earn profit of 40,000. So how can we calculate the GDP? This 50,000 plus 10,000 plus 40,000, that means 1 lakh rupees. Now what about expenditure method? So look, in expenditure method we are looking at the total spending on goods and services in the country. We are summing up all the expenditures, that means consumption plus investment plus government expenditure plus net exports. Okay, for example, if household spend rupees 50,000 on food and clothes, business spend 20,000, government spend 10,000 and net export is just remember that the net export is 3,000. So how can we calculate the expenditure method? 50,000 plus 20,000 plus 10,000 plus 3,000, that means 83,000. So in production method we are calculating how much is made. In income method we are calculating how much did people earn, and in expenditure method how much is spent. So all three should give the same GDP if done correctly. So why the three methods give the same result? So think of the economy as a circle. Production starts in a cycle, that means firms produce goods and services. Then income is generated, that means to produce these goods firms hire factors of production like land, labor, capital and entrepreneur, and in return they pay wages, rent, interest and profit. And households, they use their income to buy goods and services, and firms and government also spend on investment and public goods. So it goes like this, right? So that's why production is equal to income is equal to expenditure. Hope it is clear for you. So now let's look at this in detail. Product method or value added method. So this method calculates national income by measuring the value of goods and services produced in the economy during a year. So only final products or value added at each stages are counted to avoid double counting. So how can we calculate? For example, let's take an example of agriculture. How can we calculate the product method? we will measure the total production of major crops and multiply area sown into average yield per hectare to get the total quantity. Okay, then multiply this quantity into market price, so we will get the gross value of agricultural output. And when we deduct costs like seeds, fertilizers, irrigation and so on, we will get the net value of agricultural output. And when we take an example of industry and service, how can we calculate it? For factories, mining, fishery, forestry and so on, we will multiply total production into market price. So we will get the gross output, and we will deduct the cost of materials, repairs, depreciation and so on to get the net output. So when we add net values of all sectors, we will get the net contribution to national income. And now, why it is called net value added method? Because instead of counting all sales, which would count intermediate goods multiple times, we only take the value added at each stage. Okay, so what are the precautions in product method? We can look at the precautions. Only to avoid double counting, we can use the product method. Only the final product or value added at each stage should be counted. For example, cotton, yarn, cloth, garments, etc. are not counted. So count only the value added at each stage and not the total value again. Otherwise, the same cotton is counted multiple times. So we are taking only the value added at each stage and not the total value. Then it includes self-consumption. Okay, it includes self-consumption. For example, if a farmer grows crops for own use, their value should still be included in the national income. Like for example, rice grown by the farmer for his family counts as a part of GDP. Okay. Now, and this product method, they will exclude second-hand goods. Remember that the second-hand goods are not included while calculating GDP in product methods. Only new goods and services produced in the year are calculated or counted. For example, selling a used car does not add to national income because it is already counted when it was first sold. So think of national income as the money value of all new goods and services produced in a year, and don't double count or include old stuff. Okay. Now, let's look at income method. How can we calculate GDP or national income using income method or factor earning method? So what's meant by this income method? This method looks at national income from the income people earn while producing goods and services. So instead of counting products, we add up all the money earned by households and firms. So what are the steps involved here? First, we will classify businesses. That means divide all enterprises into groups like agriculture, industry, services and so on. Then, in the second step, what will we do? We will add all the factor incomes. For example, labor incomes like wages, salaries, bonuses, employees' contribution to social security, they are added. Then, what about capital income? Profits of companies, interest, dividends, royalties. Then mixed income like income from farming, small businesses, self-employed professionals, all these are added up. Okay, so we will add up the factor incomes. So in income method, we will add up all the money people earns to produce goods and services. Now, national income from the income method, we will include foreign sector too. National income is the total income earned by all factors of production in a country. So we will include domestic factor income, that means wages, rents, interest, profits and so on, plus net income from abroad, that means NFIA, what we earn from foreign countries minus what we pay to them. So national income is equal to domestic factor income plus NFIA. So domestic factor income will include wages plus rent plus interest plus profit, and net factor income means money earned from other countries minus money paid to foreigners. So where it is used? This method is helpful for estimating incomes from small businesses and enterprises, banking and insurance, commerce and transport, professions and liberal arts, domestic services and house property, government or public authorities, foreign transactions and so on. So income method is always equal to all the money earned by people and businesses inside the country plus net earnings from outside. Hope it is clear. And There are some things that are not included in this national income in calculating national income by income method. What are they? First one is transfer payments. These are one-way transactions, or these are payments where no goods or services are produced in return. Some examples are pensions, social security, unemployment benefits. All these are examples of transfer payments. So they are not included. Then what about second-hand goods? Second-hand goods, are they included? No. Selling used items does not create new production, so it should not be counted. For example, sale of pre-owned cars or used furnitures, they are not included in calculation of national income using income method. Then what about windfall gains? They are unexpected or lucky gains that are not from productive work used be ignored. For example, lottery winnings, gambling money, they are all called windfall gains and they are not included in the transaction. And what about corporate tax or corporate profit tax? They're already included in company's profit, so don't add it separately. So it will include incomes from current production. Anything that doesn't represent new goods or services should be left out. So transfer payments, second-hand goods, windfall gains and corporate profit taxes are not included while calculating national income using income methods. So then what items should be included? So imputed rent for self-occupied property are included. Even if you live in your own house and don't pay rent, its value is considered as income. For example, if you own a house, imagine how much rent you could earn by renting it out. That value is added. Okay, that is called imputed value of rent for self-occupied houses or office. Then imputed value of family labor is also included. That means work done by family members in their own businesses or farm counts as income, even if they are unpaid. For example, if a family member helps run a farm or shop without salary, we estimate the value of their work and include it. So the key idea is that any work or service that contributes to production, even if not paid for, adds to national income. So this is all about calculating national income using income method. National income is calculated as domestic factor income plus net factor income from abroad. In short, we can say it as Y or national income is equal to W plus R plus I plus pi plus R minus P. That means wage plus rent plus investment plus net export plus net factor income from abroad. Okay. Now, expenditure method. It is also called outlay method. National income can be calculated by adding up all spending in the economy. Basically, whatever money people, business and the government spends on goods and services in a year contributes to the national income. So GNP is equal to C plus I plus G plus X minus M, where C is the private consumption expenditure, I private investment expenditure, G government expenditure and X minus M means a net export. And private consumption expenditure means the money spent by households on goods and services. Private investment expenditure is the money spent by businesses on capital goods like machinery, buildings or inventories. Government expenditure is the money spent by the government on public services, infrastructure, defense, salaries and so on. X minus M is the net exports, that is export minus import. Exports are those goods and services sold to other countries, and imports, M, is the goods and services bought from other countries. So net export is equal to X minus M. If export is greater than import, it is positive, and if import is greater than export, it is negative. So the key idea is that this method looks at how money flows through spending in the economy rather than production or income. Now, what are the precautions of expenditure method? In expenditure method, we ignore buying old shares and bonds. That means money spent on buying existing shares or bonds does not create new goods or services. So it is not a part of national income. Here we also exclude transfer payments. Payments like pension, social security or unemployment benefits are not payments for current production. So they are not counted. We will not count intermediate goods too. Only final goods and services are included. For example, farmers' seeds or fertilizers, Yarn used to make clothes, they are all inputs, not final products. So including them would double count the same value. So we will exclude the expenditure on intermediate goods. Then purchase of share and bonds are excluded. Second hand goods are also excluded by calculating national income using expenditure method. So we will only count spending that creates new goods or services in the economy during the year. Now national income and GDP. What is meant by gross value added or GVA? GVA, gross value added. This is the value created by all businesses, that means production units in the economy. So the formula is GVA is equal to value of output minus value of intermediate consumption. What is value of output? Price into quantity of goods sold is equal to value of output. And intermediate consumption is equal to value of goods or services used to make final products like raw materials. So if businesses produce more than they sell, the change in stock is also added, that is inventory is also added. That is meant by value of output. Value of output means price into quantity of goods sold, and GVA, gross value added, is always equal to value of output means price into quantity of goods sold minus value of intermediate consumption. What is meant by net indirect tax? I had told you earlier. What is meant by net indirect tax or NIT? Taxes collected by government minus subsidies given to businesses. That means tax minus subsidy is called net indirect tax. And these are added to GVA to get GDP at market price. When we add net indirect tax to GVA or gross value added, we will get the GDP at market price. What is meant by GDP? GDP is GDP means consumption expenditure plus investment expenditure plus government expenditure plus net export. So national income is the total money value of all goods and services produced in a country during a year after adjusting for taxes, subsidies and depreciation. Now, importance of national income analysis. Why national income analysis is important? First reason is that it helps us to understand the economy. National income shows how much a country produces and earns in a year. It tells us which sectors like agriculture, industry or services are contributing more to the economy. It also shows how income is distributed among people and how much is spent, saved or paid as taxes. So it helps us to understand the economy. Next, it is a guiding light for the government policies. Policymakers use national income data to plan the country's monetary policies. Monetary policies means controls on money, interest rates and so on. And fiscal policy. Fiscal policy means the policies of government. Monetary policy means policies of RBI. So policymakers use national income data to plan country's monetary policy and also fiscal policy. This helps the government make better decisions to improve growth, reduce unemployment, control inflation and support people in need. Okay, then it also helps to formulate planning and evaluate plan progress. National income data helps the government plan the economy, like how much to spend, save or invest. It also helps check whether the plans are working over time. It helps to build economic models both in short run and long run. That means economists use national income data to create models to predict short term or long term economic trends. Then it helps to make international comparison. It also helps to compare economic growth between countries. That means international comparison. It also helps to compare economic growth between countries, between regions and across time. Between countries means international comparison. Between regions in the same country means inter-regional comparison. And also across time. That means inter-temporal comparison. So national income helps us to compare data across regions, across countries and across time. Then it helps to measure economic welfare. Per capita income, that means average income per person, shows the standard of living. So this is accurate only if income is fairly distributed. Then it also helps to understand income distribution. That means shows how income is shared among different factors of production. It helps to calculate key economic ratios too. It helps to compute important macroeconomic indicators like tax to GDP ratio, current account deficit to GDP ratio, fiscal deficit to GDP ratio and debt to GDP ratio. So in short, national income analysis is like the dashboard of a country's economy. It tells how the economy is performing, who earns what, and how the government can plan for better growth and welfare. So hope you are clear with that. Now let's move to the difficulties in measuring national income. In India, many people work in the unorganized sector or produce goods for self-consumption, like farming just for the family. Often they trade without money, that means barter system. So this makes it hard to assign a monetary value to their output. So unorganized and subsistence sector is a major difficulty. Okay, it's a major difficulty. And what about transfer payments? Yes, these are payments made by the government without any production taking place, such as pension, unemployment allowance, subsidies, interest on national debt, and so on. So why they are excluded? These payments do not create new goods or services, so they are in part of national income. In short, measuring national income is tricky because some economic activity doesn't involve money and some payments don't count as production. And what about unpaid services and national income? What is meant by unpaid services? Unpaid services are activities done by people without getting paid, like a housewife cooking, cleaning, mending clothes, taking care of children, helping friends, singing, dancing, painting as a hobby. All these are unpaid services. Why they are not included in national income? National income measures economic value in money terms. So these services are done without payment. It's hard to assign a monetary value. However, if the same work is done by someone who is paid, it is included in national income. So in short, only services that have a measurable money value are counted. Unpaid work, no matter how useful, is excluded because it cannot be measured in money. Income from illegal activities are also excluded from national income. What does it mean? Money earned through illegal or forbidden activities such as gambling, smuggling, making or selling illegal liquor are not included. Why it is not included? National income counts productive activities that benefit society. Even though these illegal activities earn money, they are not considered socially productive. So they are excluded from national income. In short, only legal and socially accepted economic activities are included in national income. Illegal earnings, no matter how much money they generate, they are not counted while calculating national income. Then, production for self-consumption and changing price. Farmers often consume part of what they produce instead of selling it in the market. For example, a farmer grows 100 kg of rice but eats 40 kg at home. And the question is, should the 40 kg eaten at home be counted in national income? Yes, because national income measures total production, not just what is sold. Economists assign a market value to such self-consumed goods. Then, changing prices or inflation or deflation, are they counted? Prices of goods and services changes over time. For example, if rice cost rupees 50 kg last year and rupees 60 kg this year, national income in current prices will appear higher, even if production didn't increase. So what's the solution? Economists calculate real national income. It adjusts for price changes to show the true growth of production, and it is done using constant prices or a price index like consumer price index, CPI, and so on. In short, self-consumed goods are included by assigning market value. Real national income adjusts for price changes to reflect actual growth. Okay. Now, capital gains. What is meant by capital gain? Capital gain happens when you sell an asset, like a house, land, or share. So, capital gain happens when you sell an asset for more than you bought it for. Let me tell you an example. You bought a house for rupees 50 lakh and sold it later for rupees 70 lakh. So, the 20 lakh profit is the capital gain. That means 70 minus 50, that is 20 lakh profit is the capital gain. Why it's excluded from national income? National income measures production of goods and services in a year, and capital gains are just a transfer of ownership, and no new goods or services are produced. Therefore, they do not add to the actual production of the economy. In short, capital gains increase your wealth, but they don't count as national income because national income only measures current production and not changes in asset prices. Now let's look at the statistical problems. Statistical problems in national income measurement. Many activities, especially in the subsistence farming sector or animal husbandry, they are not fully recorded. For example, a farmer consuming his own produce may not report it. So lack of reliable data is a major problem while calculating national income. Then language and cultural difference also contribute to that. Different languages, customs and ways of reporting make data collection difficult and inconsistent. The non-cooperation of people. Many individuals and households are indifferent or unwilling to provide accurate information during service. Then untrained statistical staffs. Some staffs collecting the data may lack proper training, leading to errors in recording or computation. Then what about margin of error? Is because of the above issues, national income estimates for India can have at least 10% error. That's why GDP estimates can vary widely. For example, between 2 trillion to $5 trillion. Okay, so in short, measuring national income in India is not perfectly accurate due to incomplete data, uncooperative respondents and human error. Now let's look at the national income and social accounting. What is meant by social accounting? It is a way to measure national income by recording all transactions between sectors of the economy. It shows how money flows and how sectors are interconnected. It helps economists and policy makers forecast trends and make decisions. So what are the economic sectors in social accounting? Firms, households, government, rest of the world and capital sector. Hope you know about firms. Firms produce goods and services. They hire factors of production. Factors of production means, what are the 4 factors of production in economics? Land, labor, capital and organization. So the firms hire these factors of production and they pay wages, rent, interest and profit to the household. Now household is also another factor or another sector. Households own the factors of production. They provide labor, capital, land to the farmers and they receive income in return, spend income on goods and services produced by the firms. And what about government? They collect taxes from households and firms and provide public goods, subsidies, pensions and other services. Rest of the world means external sector. It involves imports, export, foreign investment and payment to and from other countries. Capital sector means investment in machinery, infrastructure and other productive assets. It helps in future production and economic growth. Therefore, social accounting traces all money flows between households, firms, governments, foreign sectors and investments to understand how national income is generated and used. Hope it is clear for you. Now, circular flow with government, external and capital sector. You know that, right? Firms pay wages, rent, interest, profit to household for using their services and households spend income on goods and services produced by the firms and this creates a circular flow of money between firms and households. Government sectors are also included here. It includes all public bodies like center, state and local. Government buys goods and services from firms using taxes, borrowings or other funds and they provide goods like defense, education and public health. Public enterprises like post office and railways are treated as firms and not government in this context. Remember that. And external sector, they deals with international economic transaction. It includes export, import, foreign loans and overseas investment. It helps measure how the country interacts economically with other countries. And capital sector, it includes banks, insurance, companies, financial institutions and so on. So it facilitates savings and investment for firms. These institutions do not produce goods themselves but help firms carry out production. So what are the sectoral contribution to GDP? Economy is divided into 3 main sectors when measuring GDP. What are they? Primary sector, secondary sector and tertiary sector. There are quaternary sectors too, but while calculating GDP, we are only taking these 3 sectors. Primary sectors include agriculture, mining, forestries and so on. Secondary sector includes manufacturing, industries, construction, etc. Tertiary sector means services like transport, banking, education, healthcare and so on. So the economy is like a big circle where households, firms, government, foreign sector and financial institutions interact. Money flows from one sector to another and together they form the national income and GDP. Okay, let's move to the last part of this chapter, national income and welfare. So what it means? National income, like GDP, shows the total economic activity of a country. higher per capita income usually suggests a better standard of living. Higher per capita income usually suggests a better standard of living. Just because GDP or per capita income rises, it doesn't always mean people are better off. What are the reasons why we are saying like that? Because of the composition of goods, environmental damage, war goods, poor working conditions, etc. Composition of goods means if the economy produces mostly capital goods like machinery instead of consumer goods, people may not feel better off. Luxuries may benefit only the rich and not the poor. And environmental damage, high GDP growth that causes pollution does not improve welfare. What is meant by war goods? Producing weapons increases national output but doesn't improve living condition. And poor working condition means rising income due to child labor, overworking women or men doesn't promote true welfare. Hope it is clear. And better measure is PQLI, that is Physical Quality of Life Index, is considered as a better indicator of economic welfare because it includes standard of living, life expectancy at birth, and also literacy rate. GDP shows how much the economy produces, while this PQLI, that is Physical Quality of Life Index, shows how well people are actually living. National income and erosion of national wealth. So what it means? To increase GDP, countries often use up natural resources like forests, minerals, oil and clean water. This increases current production but reduces the resources available to the future. And the problem is that if you only look at GDP, it may overstate economic progress because the country is losing part of its wealth, that is natural resources. For example, cutting down forests to increase timber sales, that means GDP will rise but damages the environment and reduce the future timber supply. So while calculating national income, deduct the loss of natural resource to get a more realistic picture of sustainable growth. National income should reflect current production without destroying future wealth. Okay. Now national income in terms of US dollar. When we convert India's GDP into US dollar using the current exchange rate, it looks smaller compared to developed countries. Let me tell you an example. If rupees 300 lakh crore in rupee may look like $3 trillion. Just take as an example, okay. If 300 lakh crore in rupees may look like $3 trillion in dollars. Why? Because the cost of living and prices in India are much lower. So the better measure is PPP or purchasing power parity. PPP adjusts for the differences in price level between countries. Using purchasing power parity, India's national income appears higher and more realistic because it reflects the actual goods and services people can buy. Okay. Now social and environmental cost. Economic production often causes social and environment damage such as pollution of air, water and soil, deforestation and loss of biodiversity and so on. So these costs reduce the welfare of society, but traditional national income accounts, that is GDP or national income, ignore them. So to get a true picture of welfare, economists suggest subtracting social and environmental costs from national income. So let's move to the summary part. What it tells us, national income shows the total economic performance of a country. That is how much goods and services are produced and how income flows in the economy. Who uses it? Economists, planners, governments, businesses and international organizations like IMF and World Bank use national income data. And why it is important? It helps measure economic growth over time, shows changes in the standard of living of people, it enables comparison of living standards between different countries, helps assess the level of development of a country and so on. And what are the limitations that we should remember? Yes, it does not measure environmental or social cost. The distribution of income is not reflected. A high national income does not always mean everyone is well off. And non-monetized work like housework and illegal activities are not included. So the key takeaway from this chapter is that national income is a key tool to understand the economy, but it should be used along with other indicators to get a complete picture of welfare. So that's all about this chapter. Hope you understand. Thanks for watching. For more related contents, do like, share and subscribe.